How to discover the next 10x to 100x super stock. That's right, you're about to learn how to discover stocks that increase 1,000% to 10,000%. So 10x to 100x. Uh, all new, revised for 2022. We're in a very different market now than we were 18 months ago when we first did this webinar. A lot of things have changed, and we also have a lot of success case studies. So let's get right into it. Let's first start off with some of the track record we've had using exactly this methodology, which you're going to learn about right now, and how to discover the next big winners. Okay, so Cytodyne stock we introduced at 50 cents, went up to $10.01. That was a 20 bagger, 20x return right there. Visibility Group, recent one, introduced at 17 cents, hit a high of $2, 13 months later. Imagine AR from 2 cents to, I think was what, 35, whatever it is, 17x return, just a matter of months. ESC Entertainment, this stock went up 1,200% in 4 months, which is incredible. Is that going to happen again this year? We're going to have stocks increasing, 1,000% in 4 months, 6 months. You're about to find out. So here is one of our big ones, one of our biggest winners to date. Empower Clinics, stock symbol in Canada was CBDT. It's a stock we introduced at a nickel, and it increased to $2. I think it hit $2.50, right? So basically a 5,000% increase, 50x. It took about 5 months to happen. Of course, Nextech stock from about a year and a half ago, 13x. Fans Unite, 1,100%. Peak FinTech, I know a lot of people have been following that stock. It's a stock we introduced at 35 cents, September of 2020. 70 cents post split, hit a high of over $14. So that was not a 10 bagger, but a 20 bagger in 12 months, just about 12 months. That's right. And of course, we've had, stocks have doubled in a day. And look, I don't want to go through the entire list of stocks we've introduced that have increased, doubled, tripled, what have you, 5x, 7x. It doesn't count. We're only focused on the 10 baggers. So we've had a whole bunch of these. And I think the time is right at this point in time. This is being filmed February 2022, February is when we're filming this. And we're probably right now very early stages of, I think, what's going to be the next massive market opportunities in a couple of stocks we're looking at. The overall markets are kind of crashing right about now. A lot of the micro caps have been beaten down, and I think that we're going to see some massive opportunities in the next 4 to 6 weeks. So between now and May of 22, massive opportunities. Okay, so let's get right into it. This is what you're here for. What is our goal here? Our goal with Wall Street Reporter's next super stocks is, stocks which realistically can increase 10x plus. I like to use 100x. I have not had a 100 bagger that we've introduced. I have had 100 bagger stocks I got into earlier. I got in early and I got out early, but it took them quite a while to get to 100x. It didn't happen in a year. I'd like to finally get a 100 bagger. Hopefully we can find one in the next couple of months. So here is the main idea. Here is the philosophy that we're going to talk about. Number one, we're playing for big stakes. We're not, when you're in the micro cap game, when you're investing in these penny stocks or really any emerging growth stocks, I don't care if you're buying, Teladoc or DraftKings, any of these, $50, $200 stocks, Upstart, there's all these hot stocks, NASDAQ stocks. The bottom line is there's a very high risk involved in this. Think of this as, it's almost like public venture capital, right? So I think it's important that we want to be compensated as investors. We get compensated for the risks that we're taking. So you're not going to make money going after stocks which have a double or triple in them. You really need to go for things which you have a real shot of getting 10x plus. So every stock that we introduce to this program, the next super stock program, and again, on Wall Street Reporter, we have a lot of different stocks that we introduce. Not all of them are in that next super stock label, and you're going to see, when we introduce them, they're usually called next super stock, so that's the difference. So for stocks to be in that next super stock platform, here's the criteria. Again, we're looking for minimum 10x to 100x over a period of about a year, but I want to see a clear runway. A real path to at least a 3x or a 500% return within 6 months. So 10x, I understand, can take a year. It's not going to happen. I don't think we're going to see this period where we had these 50x, 5,000% increases in 4 months like we had last year. That's not going to happen for quite a while. We just had a unique market situation. I'll be talking about that in a little bit. Realistically, for 10x, it takes about at least a year, 18 months normally, a year to 18 months. But really, we want to get something where we're going to get a 3x to 5x within that 6-month period, and at least a double. I mean, we got to have at least a double in the first 45 days. So let's talk about an important concept, which is we're looking for asymmetric returns. We're looking for that fat tail. Here is a bell curve. The big secret in venture capital, I think this Peter Thiel talked about this. This is part of his philosophy, is you got to go for these massive returns, the potential, which, when you have that 20x or 50x, that pays for your whole portfolio. So let's say, you have 10 stocks, 15 stocks in your portfolio. You're going to have some winners, you're going to have some losers, but that, we're looking for that one or maybe two of those massive winners, which basically, when they go up 10x, 20x, 50x, it really doesn't matter what happens to the rest of your portfolio. You're going to basically triple or quadruple it just from those two stocks. I haven't done the math, but it should be about right. So I would like to add to that. I want to get these 100-bagger, 10x 100-bagger stocks, but asymmetric returns, the odds have to be stacked in your favor. So, we're going to talk about this in just a little bit, but, you want to get into these situations where you're not just buying a random stock. There's a great story, but the situations that we're introducing, the odds are stacked in kind of your favor. Of course, any of these stocks can go to zero. I should have said this at the beginning, but look, none of this is investment advice. Think of this as purely financial entertainment. This is very high risk speculation. This is not investing. This is speculation. You're basically, this is public venture capital. So yeah, any of the stocks we talk about, they could all go to zero. So be prepared for potential complete losses of capital. Okay, so let's go into the criteria. This is pretty important. Number one, I added a couple more of these criteria in the last couple of months to kind of better articulate this. Okay, so number one, we're looking for companies that are going after massive multi-billion-dollar market opportunities. So they're going after these massive multi-billion-dollar market opportunities. So big TAM, total addressable markets. Number two, the companies, they're at a key inflection point right now. So we want to get into these stocks, not early stage where there's way to go before they hit any kind of milestones. No, we want to get them right as they're about to break out. There's going to be some massive event, whether they're just starting to get into commercialization, or all of a sudden contracts are starting to roll in. We had that last year with a couple of stocks, or there's an inflection point in terms of, um, you know, just mining discovery, drug commercialization, any type of major event which all of a sudden sets up the path for the company for a revaluation of the stock, basically. um, and the catalysts. So basically so inflection point also is scaling. All of a sudden revenues start going from 30% or 50%. All of a sudden something happens in the market, and all of a sudden the company is able to start doubling, tripling revenues. You have this massive exponential growth. Again, catalysts, multiple catalysts. I want a situation where we get into a stock, and built into it right now, it's almost like it's built in. You're going to have catalysts which could really ignite the stock price. For example, we have a stock, Organic Garage, one of our companies on the super stock platform. So there's a couple things in that stock right now built in that could get you a 20x in the stock. Again, not advice here. But I'm using that as an example. So number one is, they're expanding a product line in the plant-based food space, where they all of a sudden new distribution, that they're going to get more SKUs. All of a sudden they can go from basically zero revenues for that line of business to 15, 25 million in revenues, and that's worth 10x revenue. So all of a sudden you have a built-in catalyst for $250 million valuation event. When are they going to get that? When they get like those 10 SKUs, let's say, they get distribution. So that's catalyst one. Catalyst number two, for example, using that case study, is they have 4 stores right now, and they're saying that they're going to launch 4 to 6 new stores this year. So essentially they're going to double revenue. So that's a built-in catalyst. When they make that announcement about launching 4 new stores, that's a major catalyst. So those are 2 catalysts. That stock has, I think, 4 or 5 catalysts built in there. Similar type of things there. So I like situations where you have a bunch of these different catalysts built in, which any one of them could double or triple the stock price. Number 4, you want to have a CEO that gets it when it comes to maximizing shareholder value. Somebody who really, look, every public company CEO talks about maximizing value. They all talk the game, right? The difference is when somebody actually, puts their money where their mouth is. For example, and again, I don't want to, this is, obviously, I have a vested interest in this, but I think it's very, very important for microcap companies to be marketing their story to investors. In other words, investor relations, promotion, whatever you want to call it. But the idea is you don't want to keep that story a secret. You want to get as many investors learning about the stock as possible, because that increases the value. Look, if you have something really great, you want to maximize that value, because the stock price very often is what makes the business. So if all of a sudden you have a stock that, triples, quadruples, all of a sudden you have massive liquidity, the company can use that to make acquisitions. They can, raise capital. We've seen all of our big winners have done that. The stock made the company. So it wasn't the business that made the company, but the stock made the company. The increase in value was what enabled them to raise capital, to build out their business, to make acquisitions, etc. It's very, very important. A lot of CEOs, they talk about this, but they don't do it. And we see a lot of those stocks. We call them zombie stocks, where they may have a very good story, good fundamentals, but nobody knows about the stock and nobody cares, and those stocks never go anywhere. Okay, number 5. I'm looking for something, again, I want that edge. When we get into a story, when we introduce a stock, I want something where we have a built-in edge. You have something where you have minimal risk. So I want something which is undervalued compared to its peer group. And that gives us a margin of safety. So this is kind of that Warren Buffett philosophy where, for example, let's say, you have companies in the sector are trading at valuations of, let's just say 10 times revenues. Okay. So I don't want a stock, when we introduce that stock, I don't want something that's 10x revenues. I want something which has a valuation of, maybe 1x or 2x. So that gives us a built-in advantage. It gives us that margin of safety. So I like things where when we introduce them, they're basically undervalued. So you have a profit already built in. So, there's two ways to make money. You can either wait for the asset to increase in value, right? You have waiting some event for an increase, or you're basically waiting for something where, the value is already there and just, kind of, what is it? It's the value is built in. It's almost like, okay, listen, everybody understands real estate. So, I'll give you an example. Okay, so it's the house. The neighborhood typical houses sell for $500,000, and you're able to buy that house for $400,000 because whatever it is, there's just an opportunity happened. I don't know. The market was slow that week. Whatever it is, I think you understand it. Same thing with stocks. You have the same type of opportunities. I believe in real estate they call it a wedge deal. I think that's what it's called. So this is it. We're looking for these wedge deals in stocks. I want something where it's already, the profit is basically built in. So you're buying that $500,000 house for, 350 grand basically. Or to use a better example, in our case, you're basically buying it for 50 grand. So you're basically buying that $500,000 house for only 50 grand. Okay. Number 6, I'm looking for stocks that are part of big themes. This is the ideal situation. So companies that are riding, major trend waves, okay, massive, trends, big themes. So, for example, in the last few years, we had some big themes. We had, let's say we had, sports betting. We had, cannabis was a theme, a couple of years back. We had psychedelics was a big theme last year, telemedicine, those type of things. So those are big themes. And, where you have, these big leaders, these big NASDAQ stocks that may have a, $5 billion, $10 billion valuation. And basically what we want that the poor man's version of that. You're essentially that stock that's trading at a $10 million valuation that could potentially become something similar. And very important, number 7, I'm adding here. This is something new. I never really talked about this that much, but I actually look at this, which is, I want a stock that has a positive chart. At heart, I talk about fundamentals, but really charts are very important. Technicals are important for timing. And super stocks are really, a lot of it is about timing. So I want things where you have a really nice chart, whether that is 2 different types of formation. Either you have a long-term double bottom, so it could be a double bottom happening over a period of a year. So basically, it's a stock that was given up for dead. Everybody gave up on the stock, and now you have this revival. Number 2 is a pattern where you may have a long bottom, and all of a sudden you have it's starting to move up. You have kind of a pennant happening, and then you have a breakout. So I want that type of thing. I don't like stocks which you're looking at a chart and the stock went from 10 cents to $1. And now I don't want to be introducing that to you at $1. Okay, we have had that situation before, saying, okay, so that dollar stock is now going to go to $10. Very, very, those are really, really hard. We've seen a couple of those things really not work out well. So I want things which have been de-risked. Okay, what's the secret formula? What do we do different here? I mean, like a lot of people talk about, yeah, we're going to introduce you to these 10 baggers or whatever. There's all these paid newsletters out there that have, their methodology. Okay, so we have a secret formula. Here is what it is. We take a stock which has a great fundamental upside story, and then we take that story and we give it massive global investor exposure. Again, we're in the investor relations business. You want to call it stock promotion, whatever you want to call it. Okay, but what we do is, we introduce companies to massive global investor audiences, and what that does is it's almost like, you take the Rolling Stones. I don't know if anybody knows the Rolling Stones. A lot of people watching this are probably younger. So, I'm going to use I don't know, Justin Bieber, whatever it is, Rolling Stones. There's a difference if, they're playing in a bar with, 50 people in the audience, okay? Or if they're doing a stadium tour, 50,000 people, one city after another. I mean, which musical group do you think is going to be more successful? The one that plays in a bar, the neighborhood bar, maybe once a month, whatever it is, or even weekly, or the one that goes on the arena tour. So that's what we do. We basically take a great story, we take that great band, and we put them on a tour, on a global tour of arenas, 50,000 person arenas. Essentially, that's what we're doing with Wall Street Reporter. So what that does is that increased audience creates increased demand for the stock. It's very simple. The more people know about a great story, the more demand there is for that stock. So that valuation gap closes. So when we say that we're looking for that stock which is undervalued to its peer group, the peers are trading at 10 times multiples. We're introducing that stock that's 1x, so it's $1. The theory is by this increased exposure, that gap is going to close from $1 to $10. So that's your 10-bagger built in. Look, there's a lot of great stories out there. I'm sure everybody's watching this video right now. You all know about those companies that have great investor stories. The problem is a lot of these, especially if they're penny stocks, microcaps, they're never going to go anywhere. They're going to be zombie stocks because nobody knows about them. And the CEOs of a lot of those companies, they don't get it. They don't understand that you got to get the story out there. You have to do promotion, as we called. You gotta get investors interested in the story, because if you don't do it, nobody knows about it. It's like, if a tree falls in the forest, we have this little cartoon here. If a tree falls in the forest and nobody hears it, did it happen? Does it exist? So you have so many of these stocks that, nobody knows that they exist, and they're basically zombies. So because of that zombie type of stock, they can't access capital, they can't do M&A because their price is too low. They can't get good management because they can't give them nobody. Why would somebody want to join them if they're not going to get stock options that are worth anything when they can join, I don't know, Facebook, whatever it is, any startup that gives people options. So let me give you an example also, and the reverse of that. You have companies that, in theory, the CEO gets it, they start doing promotion, and then all of a sudden they stop doing that. They stop talking to investors. They basically stop doing investor outreach. They give up on retail investors, and it goes in reverse. I mean, we've seen that happen again, and we've seen real life examples. Take a look at these two symbols here, DOC, SLHG. So CloudMD, stock we introduced at 50 cents, it went to, I think it was at 250. Skylight, the same big run up. So you had these massive moves, massive volume increase. There were 5 baggers, 4 baggers, whatever it is. And for whatever reason, I don't know what the reason is, but, right when at the peak, right when, we were getting these massive audiences, of the CEOs decided, okay, you know what? We're going to move away from retail investors, and we're going to, I don't know, only talk to institutions or whatever. Basically, they stopped doing promotion. What we saw happen there, if you look at those charts of CloudMD, DOC, SLHG, you had a ski slope. They went basically in reverse, straight down, versus a stock like RHT, Relic Health, where they were doing same exact sector, telemedicine, telehealth, whatever you want to call it, health tech. That stock actually is near new highs right now as we speak, because they kept doing that promotion during the same period. So you have 3 companies, same exact space, more or less, and 2 of them are down by 75%. One of them is near new highs. Okay, asymmetric setups, extremely important. Again, I don't want that stock where you're buying it at $1 and the upside is maybe $2 or $2.50 or even $3. That's not a good risk reward ratio. I want asymmetric gains where you're risking $1 to make $10 or $100. And very often it's not even $1 that you're risking. A lot of times that I'm using an example of $1 stock, but it could be a 5-cent stock. On that dollar stock, the downside could only be maybe limited to maybe 75 cents, so might drop another 30 cents. So basically you're risking 30 cents to make $10. That's a 33 to 1. I like that. That's a good asymmetric setup. And so again, your reward is at 10x, 100x upside. The risk, the average risk again is about probably 50%. So, once a stock drops 50% at that point, and again, we've had, if the company's doing all the right things, it's probably not going to go any down further. The only times we've seen stocks really drop that much was either they stopped the IR program, the promotional campaign, so they basically fell off the radar, or fundamentally, basically, their velocity slowed down. They stopped putting out news flow. We're going to talk about that. Extremely important. And they fell off the radar. So the edge that we have, with this asymmetric is the built-in promotion. Again, the difference between the stocks that we introduce as next super stocks and, I don't know, your average micro cap that basically is, hoping for, relying on, great fundamentals, the big delusion that a lot of these CEOs have, when you're dealing with these amateurs is when they think, oh, the business is going to take care of, the stock price. Yeah, when we do well, the stock price will take care of itself. That happens to be true over a period of 100 years or 20 years or 15 years, okay? It does happen. If a company really delivers over a period of 15 years, 10 years, the market probably is going to catch up to it. The reality is microcaps, they have a very, very short runway. They don't have a 10-year runway. They got to make it happen, make it or break it in like 12 months, 18 months. If they don't make it in that window, they're just going to become, fall off the track, fall off the radar, and they'll become zombie stocks. And here's what I mean. Time is money, okay? So, when you're in the public venture capital space, when you're doing this disruptive innovation these companies are doing, you want to go as fast as possible. You want to go as fast as possible, as far as possible. And that requires a stock price that's moving up, because that high stock price, it attracts M&A opportunities. It attracts capital without dilution. It attracts talented employees. So, the stock price, it's the tail that wags the dog a lot of times. And again, we're not doing pump and dump here. That's not what I'm talking about. I'm not talking about, creating things where, the value is not attached to the reality. Although that does happen in a lot of cases. But yeah, we're just talking about getting a stock to fair value. Okay, so let's talk about some things we've learned from our 10 baggers. Success leaves clues. You've heard that expression, and it is absolutely true with these stocks. Success does leave clues. Here's what we've learned: the difference between the big winners and the losers. These companies have a very short window. So when we introduce a stock as a next super stock, it's basically make it or break it in 45, 60 days. So, and that means is either they come out of the gate and you start seeing traction right away ideally within the first few weeks, worst case within 6 weeks. Some companies, it takes them a little while to get traction. It could take 4 to 6 weeks sometimes. But here's what we're looking for. We're looking for, number one, news flow, okay? So, one of the things we say, hey, when we introduce a stock on a platform, it's got to have those catalysts, inflection point, and what is symbolic of inflection point and catalyst is news flow. So, when a company has, major news that they're putting out once a week, every 10 days, 3, 4 times a month, that tells you the company is going places. It shows you this is a company on the move, and people start paying attention. And of course, when you start seeing the CEO on a program every 2 weeks, you're getting updates, you're getting the sense of momentum and velocity. Okay, so those are two very, very important things. Momentum and velocity is what people pay for. So, you're not going to pay 10 times revenue for a company that's, growing 20% a year. Of course not. The market will pay 10 times revenue for businesses that's, growing exponentially or has that potential. So, it's going from 50% to 100%, 300%, massive growth, and very quickly. So you don't want to see that growth happen over 5 years. You want to see that happen over 5 quarters. So a year and a half. You want to see fast action. That's what investors want. They want to see that action within 6 months. Now, I showed you those great looking charts. You saw those stocks that went up 10x, 50x. It's very exciting. Everybody thinks, yeah, I'm going to hold on, or as they say online, hodl. And this is the cartoon. It's a straight line. You're riding from the bike to the moon. It's a straight path to hodl, to the moon. The reality is, as you see in this little cartoon, you have pits and falls. You have all these various hazards, disasters, a lot of things. You have short sellers. You have listen, as you see on the right, this little album. I think it was an album cover from, of course, AC/DC. It's a long way to the top if you want to rock and roll. That's their famous song, and that is absolutely true. It's a long way to the top if you want to get a 10-bagger. Okay, it's not easy. So, how have things changed this year versus a year ago, 2 years ago? Okay, class of 2020. So those are stocks that we introduced. Let's call it between September of 2019 to December of 2020. So that kind of window. So during that time, we had Nextech, Cytodyn, a couple of others, and of course, we had a lot of the big winners. During that period of time, I think this might be, I don't know if these numbers are accurate, but it seems to me that probably 75% of the stocks we introduced became 10-baggers. I don't know if that's an exaggeration. Maybe it could have been 50%, a huge number. And they all went up. Everything went up, at least became a double. No, we did have one or two that kind of faded out. But yeah, it was very, very high success rate. We had like in one stretch of time, we had during the month between December and February of last year, we had, I think, 5 stocks that increased 10x. You had Fans Unite, ESC Entertainment, Empower Clinics. Who else? That's 1, 2, 3. I think CloudMD went up like 4x. You had Red Light Hound went up 7x. I think we had another one I'm forgetting. Yeah, but there was a bunch of winners. Now, you see you have a bell curve. I'm showing you that bell curve at the bottom. Everything reverts to the mean. By the way, it's not normal to have 75%, like everything become a 10-bag, everything. That's not normal. And last year, what happened was stocks that we introduced in the period of between last February and this year. So during that 12-month period of 2021, it seems like almost everything, either you had a small pop, you may have had a 50% pop, a double. We had, I think the biggest, in terms of new companies, the biggest one was a double. We had a bunch of 50% type gains, and a lot of them faded out. A lot of them fizzled out. You had companies that came on the platform, they didn't deliver news. You had a lot of disasters last year. Well, let's just say we had a lot of dogs. We had a lot of dogs. So, you had one year we had like almost all winners, and the next year it was like almost all dogs. So, those are two different extremes. I think now things are going to be more normalized, and this is the normal situation. Here's what you should expect. I expect the stocks that we introduce right now, between now, the next 12 months, 15% of them are going to become 10 baggers. So, we're probably going to introduce, let's just say 20 companies in the next 12 months, maybe 15, 10, 15, whatever the number is. That also includes some of the ones we have right now. So, so let's just say 20 companies. Out of those 20, 15%, that's 3 will become 10 baggers plus. You may have a 20 bagger or 50 bagger, very possible. So that's going to be 15%. I think about 40% of them are going to have moves between, they'll double, triple, quadruple, maybe a 5x. That's going to be like 40%. And then the other 45% will be dogs, which is that's the reality. Like normally when you're doing this type of high risk, high reward, you should expect that 45% of it is going to be dogs. And that's how the venture capital business works. When a VC puts money into a company, they know that out of, let's say, 10 companies, one is going to be a 10 bagger, one is going to be a double, 2 are going to go nowhere or whatever. And 5 of them are going to flame out, go to absolute zero. So they expect half of them or more are going to go to absolute zero. And they're going to get that one stock or that one company that they invest in, which is going to, go to the moon. That's what I'm expecting. So I'm expecting about 15%, so a little bit better than normal. I'm expecting about 15% to be 10 baggers, 100 baggers. About half will be, will do very, very well, like, triples, quadruples, 5Xs. I mean, like the type of returns anybody's going to, dream about. And about half, 45% are going to go nowhere. They might drop 50%. You're going to have, a few that are going to go to absolute zero. It's going to happen. Okay. So let's talk about the reality of 10 baggers. We got a picture of, Wayne Gretzky there. His famous quote is, "I skate to where the puck is going." Okay. So in other words, he's heading, he's not chasing after the puck. Okay. So the puck is here. He's skating over here because he knows the puck is going to go there at some point. So you gotta be ahead of the curve. So it's like, look, if you want to get on top of that massive wave, you want to ride that big wave like a surfer, you got to be in the water waiting for that big wave. You got to be in that spot where the waves are going to be. You can't be, hanging out on the beach, drinking a beer and hoping that, you see that wave coming in and you're going to have enough time to jump in and get there. No, but if you do that, by the time you get in, that wave is going to come crashing over you. So that's kind of the reality. So here's the thing. Right now, we want to get on the ground floor in preparation for where the trend is heading. So we want to get ahead of these trends. Which themes, which sectors are going to be hot in 6 months. I spent a lot of time thinking about that, and that's kind of what I'm looking for. I'm looking to know, what is going to make a comeback. Are psychedelics going to return in 6 months? Is, I don't know, esports stocks or, the gaming, sports betting stuff. Is that going to make a comeback? We've seen a lot of those things drop, 90%, DraftKings, Fubo, Penn. Okay. Number 3, buy the rumor, sell the news. Okay. This is very important. you want to get into these stocks before, the big event that everybody's talking about. So you want to get into them. That's kind of the risk you're taking, of course, also. Everybody was saying, okay, well, I'm going to use Organic Garage as an example. You want to get into that stock now before they have, all those CPG products, the plant-based lines, et cetera, and they're making, 25 million a year. And that line, they double the store count. They got 8 stores. All of a sudden they're doing, 25 million in plant foods. They're doing, 50, 60 million in the retail. And all of a sudden now you have, a $600 million valuation, right? And that becomes a 30 bagger from where the stock is right now, right? 30x from here, $10 stock. You don't want to be buying Organic Garage once they already have those events happen, because by then it's all fully priced. You want to be selling that stock then. So you want to be getting out of that stock and going to the next thing, right? So you want to be getting out of these things when the trend already, when that theme becomes hot. You want to buy now, buy the rumor, buy when everybody hates these things, nobody believes it, and then you want to sell it when everybody wants it. So you want to get positioned in kind of the penny stock version of, the big trend leader. So for example, if you had DraftKings was the big, theme leader in sports betting, whatever it is, Fans Unite was kind of our bet on that sector, and it was only 17, was it 20 cents when we introduced it? Yeah, 15 cents I think it was. Yeah, whatever. It was very cheap. It became a 13, whatever the number is. It was more than a 10x. Same thing with a lot of cases like that. So you got to be in the water if you want to get these 10 baggers. You got to be in there. You can't be chasing after them once the wave happens. So here we have the reality of 10 baggers. We have if anybody saw the movie Basic Instinct. I don't know. This is Sharon Stone, of course. Incredibly beautiful woman, right? In that movie. I don't want to ruin the plot for anybody. What is it called? Plot. What do they call when they tell you the ending, whatever it is? But here, there's ice pick involved. So nobody is perfect. Okay, you can have the most beautiful woman in the world. They all come with problems. Okay, so these stocks, all of our 10 baggers, they all came with problems. None of them were perfect. Okay, so it's there's never a perfect 10. There's always an issue. So for example, Empower Clinics, when we introduced that at a nickel, there was a lot of unsolved issues where nobody knew exactly what they were doing. There's a lot of random stuff. Same thing with Peak FinTech. Next Tech, nobody knew whether are they in the AR business, are they in the dog food e-commerce business. You had kind of like an overhang on those things, but it's those things which create the opportunity. Okay, if it was absolutely perfect, you would never have a chance to buy those stocks at those prices. Okay, so Peak FinTech, if they were doing 100 million in the China fintech business, when we introduced them, it wouldn't be selling at 35 cents. It would be, $10 plus. So you want to get into these things when, you have, questions there, there's a little danger involved. You have a lot of haters. The more you see haters on message boards, people bad mouthing a stock for like no real logical reason. And then you see them consistently being wrong, that's when you have a real winner. So, the more haters there are, that creates more upside because, I think, these online haters, these trolls, it's just I think they're just confused fans. It's misplaced admiration. It's basically people who really want to buy the stock, but they feel they missed out or whatever it is. So, and those people are eventually going to buy the stock. So haters create an opportunity for upside. So you got to get into these things when, they're not perfect. Uh, the ideal thing, I call them cigar butt stocks. Actually, I'm getting that name from Warren Buffett and, his mentor, what is it, Graham, right? The guy who wrote the book on value investing. So cigar butt stocks, I think that term that he used referred to when they were deep value investors, they would buy, it's almost like a guy who walks around and picks up cigar butts on the ground. So here's a cigar. It's not quite a butt, but it's almost gone, right? And so there's not a lot left. I mean, the cigar was this big, right? So there's a very little left here, right? But this is also the tastiest part of the cigar, ironically. But so, the cigar butt investor picks them up on the ground for free, and they're basically free. So, right? So it's free, and, you smoke it, and there's your cigar. Instead of buying a brand new cigar. So it's that type of thing. When you have these 5-cent stocks or these very, very cheap stocks that everybody hates, it's almost like that cigar butt that, nobody wants it. But I mean, it's perfectly smokable. I mean, if you pick this up on the ground, right? I'm using that actually, that's a very good metaphor. If you saw the cigar, now this is, let's say, a $10 cigar, brand new. You find that on the ground. You pick it up, right? Let's say you're not worried about germs. I mean, this is delicious, this cigar. Right at this end, this is when it's the best taste. But not everybody's going to pick it up off the ground because they think, oh, it's disgusting. Oh, it's whatever. So, you got to, hold your nose a little bit, so to speak, when you buy these 5-cent stocks. When, they look ugly, because that's when you have the most opportunity. Empower Clinics, CBDT. You got that 50 bagger, 5,000% return because, it was so ugly at a nickel. We see that same situation right now with we have a couple of nickel stocks or the 10-cent stocks. We got a couple we're going to be introducing in the next few weeks, kind of in that range. PHRX right now is a nickel, Canadian nickel. That's a pharma drug. It's a nickel stock. I think that stock can go to $1. So I think it's got a 20x upside. It looks very ugly right now. It's completely imperfect. But if it was absolutely perfect, you wouldn't be paying a nickel. You'd be paying $2, and then it could, give you that ice pick. By the way, here's why I'm using the Sharon Stone example, right? So, you have this, perfect 10, whatever it is, right? Very smart, everything, so you think, wow, this is the most perfect woman in the world. And that's when you get the ice pick. So it's those stocks. Everybody thinks, oh, DraftKings at whatever, or Teladoc at 200, or Facebook at whatever it is at $300. Absolutely perfect. What can go wrong? Why should I buy these penny stocks when I can buy these beautiful, perfect stocks? Well, you're going to get the ice pick. Have you seen the chart for DraftKings or a lot of or ARK, or any of these, disruptive innovation stocks? They're down 75%. So yeah, believe me, you can get the same downside with the bigger stocks. Very important, risk management, capital allocation is your best friend. Last year I did a webinar. I had to, parlay $1,000 into $1 million or 10 million, whatever it is. And yes, you can do that. If you're completely, you do that, YOLO trade, you put all your money into one stock, it becomes a 10 bagger, you parlay that into the next stock. You do that 3 times and, $1,000 becomes $1 million. Of course, that is extremely risky and it's insane. Have people done it? Yes, we know if people have done that. You met them on a live streams before. But the reality is, if you're like a sane individual, you're going to spread your risk around 10 stocks or more. Okay, this is the first time I'm going to be talking about this. Is extremely, extremely important. When to get out, when to take your profits. Okay, so a lot of those charts that I showed you earlier, those beautiful charts, they went up 50x, 20x, 10x. Today, a lot of those have come crashing down, and And a lot of people are, I get people saying all the time, oh, all your stocks are down. Everything goes down. This is pump and dump. Well, first of all, we don't give advice. Did I tell you to buy the stock at a nickel? No. Did I tell you to sell it at 250? No. We introduce you to the story, but you have to know when to get in, but also even more important, when to get out, when to take that parachute and jump out of the plane. There's an expression called drinking the Kool-Aid. Everybody heard of that expression, but it's actually, I had to explain it to somebody the other day, and so I'll give you a little bit of a history lesson. It all comes from Jim Jones in the Jonestown Massacre. You see the guy on the right, that's Jim Jones. From what I understand, actually, Leonardo DiCaprio, the famous actor, is going to be doing a movie about Jim Jones. So Leonardo DiCaprio will be playing Jim Jones. It's going to be pretty crazy. But what was the story with Jim Jones? I encourage you to look this up on Google. Google Jim Jones, Jonestown. It's a crazy story. It's an insane story. It's actually very relevant today. But okay, bottom line was Jim Jones was like he had a couple screws loose. I think he was I don't know if he became a Pentecostal preacher. He became some sort of minister in a new type, ostensibly a Christian church, but like it was a Pentecost. It was he had his own kind of angle or whatever it was. And he started off, I think, in Indiana. And then he moved to San Francisco in the 70s. Of course, anybody knows San Francisco. That's where all the, you think it's crazy today. It was really crazy in the 60s and 70s. You had everything in California was crazy. You had, what's his name, Charlie Manson there. You had, all the cults, all the wacky stuff starts in California, right? So Jim Jones was basically he started this church. I think it was called the People's Temple or whatever it was. Ironically, he was a white guy, but most of his members of his congregation were black, right? So it was like an interesting situation. And basically, he became very powerful in San Francisco because he sold basically sold votes, because he was able to tell a politician, okay, hey, I can deliver you, this whole group of, 10,000 people who are going to vote for you, right? So he got all sorts of favors. I mean, he was very tied in with the left wing of San Francisco politicians, including Nancy Pelosi, who is the famous mayor of, like all these guys. What's his name? Brown, Willie Brown, I think it was Willie Brown. Yeah. Willie Brown, who was the boyfriend of Kamala Harris, who's today the vice president, right? So Willie Brown was like best friends with this guy and high supporter of him, right? Anyway, Jim Jones, he's got all these believers. He says, hey, there's going to be an apocalypse. We're all going to go to Guyana, which is in South America. So you have all these believers, and they all get on the plane. They all go to Guyana. I think there's a couple thousand people. Next thing you know, something happens. I think he says the apocalypse is coming. I think there was a shootout with there's some weird stuff happen. Anyway, he basically says, hey, we're all going to have to commit suicide. He basically pours he makes everybody drink Kool-Aid from these, I guess, punch bowls, Kool-Aid bowls, but he puts cyanide in them, right? So you get a couple thousand people that drink this cyanide-laced Kool-Aid, and I think 800 people died in the jungle. I think some people escaped because they said, hey, shit, we're leaving. We're gonna get out of here. So that's called drinking the Kool-Aid. That's what I mean. It's a very tragic story. I mean, it's a tragic story, but what is the point? So there's 2 points you can, but before the whole Kool-Aid episode, Jim Jones, he had a great thing going. He really had like a phenomenal run. I think he was very powerful in San Francisco politics, and I think he got free housing for people. He got there was a lot of political favors done for the followers that he had. So the point is, you want to, any of these stocks that we introduce, think of them as miniature cults. They become cults. They develop a cult following. That's what makes them go up, is the cult following. And the CEO of the company is the Jim Jones. Maybe I shouldn't say this. It's not going to sound popular, but yeah, they become this kind of cult type of figure. So you want to get out before they start passing around the Kool-Aid. You want to leave the cult before they go to Guyana, or even let's say they go to Guyana, you want to leave before the Kool-Aid starts getting passed around, right? You want to, get off the ride by then. So how do you know when you're inside of a cult? How do you know when the stock that you're in, this 10-bagger stock, is actually a crazy cult where Kool-Aid is about to be passed around, and the drinking of the Kool-Aid, everybody's starting to chug the cyanide Kool-Aid? Here's some hints. When you go on message boards and forums, that's when you see the craziness. I like to follow these, whether it's CEOCA, Investors Hub, Reddit, whatever it is, social media, and you kind of see how people are talking about these stocks, how investors are talking about them. So here are some examples of delusions, cult delusions. When people start taking these stocks personally, when they get personally attached, when you hear expressions like, our beloved, XYZ stock, our baby, PKK, whatever, or our fate, or this is going to be 100x, or for example, I'll give you examples. Next Tech, all of a sudden, when nobody believed in the stock was, 50 cents. And I did say, hey, this thing could be a $10 stock. Sure enough, it went very close to there. It became a 14 bagger plus. But nobody believed it at, from 50 cents to $1, $2, $2.50. Nobody believed it. All of a sudden, at $4 or $5, everybody on message boards went crazy. They were all saying, "Oh, this thing is going to $60. It's going to 100. I'm gonna create generational wealth because it's going to go to $100." Now, do the math. The odds of that stock going to $100, that means if that stock went to $60, that means the company will be worth $10 billion. Just insane. I saw the same thing happen with Peak FinTech, PKK. People saying, "Oh, it's going to go to $40, $50." After it was already really overextended. By the way, I don't mean to pick on these companies. They're just emblematic. Or CBDT. When that thing, nobody believed it at a nickel, nobody believed it at 40 cents. Sure enough, the stock breaks out to $1, goes to $2. At $2, if you go on the message boards on COCA, people are saying, "Hey, this thing is going to $10. I mean, I actually had a lot of people like, when I said, "Hey, this thing is, it's getting close to the top here." I didn't say it's getting close to the top, but look, usually, generally speaking, our engagements with the companies last usually 6 months or so. And if a stock already went up 10x, 20x within a 6-month period, I mean, realistically, it's not going to go up another 20x from there, right? So, I don't want to really be working with a company if I don't see any real upside. So, we don't bring it back, even though, yeah, sure, we're going to get paid very well, actually. But, I'm really looking for those opportunities where a stock can, go 10x, 20x. Once a stock has already increased 10x, 20x, I'm really not interested. I'm looking for the next deal. I'm not here to do traditionally you have all these IR firms, these promoters, they try to milk companies along for years and years, to get that monthly paycheck coming in. I really don't want that. I just want that 10-bagger and move on to the next deal. I'm looking for the new thing, the next new thing. So when you see people saying these, they really start taking things personally. And then when you hear anybody, who voices anything other than, absolute worship of the company or the story, people start, cursing them out or getting them, kicked off these forums or, what have you. So basically any type of dissent gets shut down. And anybody who's taking a profit or sells, they're seen as traitors almost. Let me tell you something. There's nothing wrong with taking a profit after a stock has increased 10x. I mean, you should actually, I say this a lot of times, you should really pull your principal out, after a stock has doubled or tripled. So, let's say you have 10 grand in a stock, it triples, pull that initial money out, let the rest ride. Or, I mean, you could have any different permutation of that, different variations. Maybe wait till it goes up 5x, then you pull your principal out and then let it run. But yeah, there's nothing wrong with taking a profit. I highly encourage it, especially when a stock is up 10x, because the odds of a 10 bagger going up another 10x, it's like this small. It's almost non-existent. Rarely happens. So you want to start packing the parachute when you see this type of behavior, when you see, people taking these things very personally, when they start extrapolating, price targets to the moon. This thing is going to go from, $1 to $100, crazy talk like that, especially after it's already made a big run. So, it's one thing for people to be saying, hey, this thing could be 100 bagger when the stock is a nickel. It's a completely different story when that nickel stock is now $1. Once that stock is $1 and you see people saying, oh, this is going to go to $20, back up. Get that parachute, strap on that parachute, and, you may not want to jump out the plane that minute, but you want to be ready. You want to be, that's your exit. Keep your, make sure you have your eye on that exit there. Your exit. Because, when everybody yells fire in that theater, you have a mad rush for the exits. That's when you see these things collapse. Like that CBDT chart, others. So rules for profits, 5 rules. Number 1, get in early into these things. You got to get in the ground floor. Right when we introduce a stock is usually a very good time. When the stock is a nickel, you get in the water, getting ready for that big wave. Now, number 2, do your own research. Don't believe anything I say. Don't listen to anything I say. I'm not here to give you advice. Nobody here is here to give you advice. Do your own due diligence, as they say. Number 3, this is the most important rule, I believe. Manage your risk capital. Don't put all your money into one stock. Spread it around. I don't know if you want to put 5%, 10%, whatever the number is, whatever you're comfortable with. Everybody has that money management philosophies all across the board. But yeah, don't put all your money into one stock, or even half your money, or even 25%. 4, know when to cut your losses. Cash in, take profits. You got to take your profit when a stock goes up 10x, when something goes parabolic. That's a good time to get out. For example, Peak FinTech. Our program with them ended last, I don't know. I think it was last June. I think I actually gave them a couple of free months, so technically it was earlier. But yeah, so basically last June, July, the thing was over. The stock was already up, I think, $10, $12. And, I put out a message to our group here on Telegram. By the way, I highly recommend you join our Telegram channel. It's free. Saying, hey, you might want to pack the parachute. This thing, I could never say sell, because look, it's a conflict of interest. I would never say sell a stock, which is a client company, because, it's just a conflict of interest. So what? So because they're not paying me, then it means you sell the stock? No, that's not what it means. There's some great companies that, for whatever reason, may decide it's not in their best interest to continue promotion, or whatever the reason is. Everybody has different reasons. So I could never say sell, but when a stock is up 20x, where is it going to go? It's going to go up another 20x from there. So the stock went from 70 cents to $14, post split. And there was a lot of people on social media saying, oh, it's going to go to $30, $40, $50. I mean, you go back on COCA. And, these people are holding massive bags because that stock went from 14 back to, I think it's at, $4 right now, less than $4. And again, the business is not the stock. I mean, I think their business is better than ever today. But, just the stock needs to, the business basically needs to catch up to the stock price or vice versa. Same thing with Nextech or CBDT. Those companies today their business is much more impressive, much bigger, much more successful than it was when they were at those crazy valuations. But the stock is not the business. You got to understand those are two very different things. Yes. So number 5, look, it is not personal. So the stock doesn't owe you anything. The company doesn't owe you anything. The stock doesn't owe you anything, and you don't owe the company anything. When you have an opportunity to make 10x, 20x, sell, take a profit. It doesn't mean you're disloyal to the story or the company. It's not personal. I know people take these things very personally. I know that there's I think on some of these disgruntled investors who are holding these bags in these companies, when they could have gotten out, they're blaming me as saying, Jack, badmouths companies when he's not working with them anymore. That's not the case at all. I do, we do announce that when, we're not working with the company anymore because people want to know, are you working with them or not? Because they see that, a lot of times, once a company stops the promotion or whatever it is, that big run up usually reverses or things change or what have you. So there you have it. We just talked about how to discover these 10x to 100x winners. We'll probably be doing an update in a couple of months. So there's probably going to be some new things happening in the market. But let me just say, if you've watched this far, an hour into this, please press the like and subscribe button on YouTube. Join our channel, join our Telegram channel. Also, we are on Discord. And where else? Of course, wallstreetreporter.com. And here's to your next 10 bagger or 100 bagger. I hope the next time I do an update on this, we have some new success case studies. I'm looking forward to our first 100 bagger. And hopefully it will be, the seeds of it will be planted this year, 2022. See you then.